dealing aspect of, and the larger context is how can we access to finance in our economy, make economic diverse sections of our. This is the larger problem statement that we are dealing with. Okay, let's start from the basics again. What are the factors of production? Land, labor, capital, enterprise. We are dealing with the aspect of capital. So when you're talking about capital, first place that you have to look at is financial interest. If the health of the financial interest is bad, indicate that the economy will not function properly. So that is the first aspect. When you're talking about financial independence, we started with banks, the most traditional financial industry in Indian economy. Within that, there are two aspects. One is the interest rate. This is linked to current account deficit and inflation. Saw how inflation targeting will impact how the market performance will also determine interest rate. And after fixing that, the entire issue of repo rate and how it will be transmitted to the next players in the segment. Saw the issue of repo rate, the policy making, and then we were talking about monetary policy transmission. Just because RBI was passing on, just because RBI is reducing the repo rate, doesn't necessarily mean the market players will also pass it on to the customers, right? So this is the monetary policy transmission, and here we're talking about the transmission. We were discussing about the issue of liquidity. What are the measures taken by RBI to liquidity, market operations, how they dealt with US INR swap, all these issues that we discussed today. That part is over. Now, what are the other areas where you can think improve credit access? Okay, we're talking about the traditional banking sector. We've done a lot of things in improving efficiency of the banks, and in that regard, we were about to discuss one, namely insolvency and bankruptcy. Let's try to understand the insolvency and bankruptcy code before we move forward. What is the purpose of IBC? It was brought in with a specific problem, like to address a specific problem. If I have to address that problem, I need to know what were the efforts previously to. Once those efforts failed, IBC in 2016 was presented as a solution which is better than the previous versions. Now it is not important to get into the specifics of those previous efforts, because I don't think UPSC is asking those. Even if you get, anyway, getting integrated in IBC. IBC is dealt in your basic classes, so I am expecting that you know some basics about what this topic. With that presumption, whatever is discussed in economic survey, once you are talking about GNPA, what do you mean by that? Banks are struggling to cover that amount. So once it is concluded that you are not going to make any money out of it, fine, like you will deal with that scenario. But if it is not certain, that is where confusion, certainty. Like nobody running a good business would want to be in losses. They would want to repay those loans and carry forward the business. Nobody would want to be in a situation where they will end up not paying the money, right? So when you're talking about NPAs, let's try to understand the entire technical jargon of IBC, whatever our survey is talking about. In an example, let's say there is a steel company. It took a loan of 100 crores. So it imagined it will make much more than 100 crores. That's why it is taking 100 crores. anyone who is taking a capital obviously hope that it will at least make 120, 30, 40 or whatever it, that annual revenue, like year after year, it is growing fine. Otherwise, it will barely manage to not business, its value will come down than the actual capital. That is when company will decide, sorry, I can't pay the, I did my best. It is not easy for any company let go of its dream, but to accept that failure is an emotional decision for the company, but a very practical decision for an economy, for a bank. Failure is a part of the structure of economy. When there is a competition, one player will win, other player will lose. As a state, we have to support this competition. So, if the economy doesn't allow a proper cushion for failure, you are saying that we don't want anyone to fail. That's not how it works. Efficiency comes when there is competition. The role of the state is not to say that everyone should win. That's just wishful thinking. That doesn't happen in reality. Competition thrives on efficiency and market performance. Right. Now, here is where you will have to understand some technical terms called going concern. When you're talking about a company is making losses and a bank or a group of banks which gave loans to this company. Let's say there is a company called steel factory or steel maker. Let's say Steel X. This company borrowed 100 crores. It thought it will do business, but it is not doing. Today, as of now, see the valuation. A independent valuator come and see what is the present valuation of this company, and that valuator will say 60 crores. This 60 crores as of today, if it is allowed to continue being concern, means if the business, even if it is making a loss, is allowed to function as it is worth 60 crores, much less than the 100 crore loan that it took. This going concern as a concept, if allowed, value that we arrived at called fair value. Okay. This is the fair value of the company at this point in time. So now the committee of lenders gave the loan entrepreneur. They will have to decide. There are two ways to go about it. Either decide that no, there is no hope for this company, dismantle everything, sell it as a scrap, and get whatever amount that we are getting. Okay? This is called liquidation. Please understand this term. Let's say a steel factory will have its machines. There will be a asset value to that machine. So it will depreciate over a second-hand machine. There is an underlying land value or whatever assets that company have. It can be laptops, computers, everything that you will sell. Maybe that liquidation value is roughly around 35 crore. One option. Then there is a second option called resolution. What do you mean by this? At this point, you are saying that the fair value of the company is 60 crores. The committee of lenders now hire a professional who is willing to find one more person willing to take up this company SteelX at slightly lower price than this fair value, then intent to revive this company, make profit out. Okay. Maybe sometimes, for example, SteelX is a company which wanted to come bigger player like Tata Steel. Tata Steel did not want to take the headache at that point of time for a new plant because securing a loan, paying up the capital, etc., is a huge risk at that point of time. This person was able to take that risk, failed. But now Tata has additional capital, or it thinks that so-called fair value is a good deal. You are now getting a deal at a price lesser than the fair value. So Tata still will come up and say, okay, I'll offer you 50 crores. Let this 10 crore margin be my profit because I am also carrying that risk today. So there is resolution here will actually revive. This bad firm will not make profit, have a second passionate on to see their dream getting mistakes that they must have committed will be passed on to the next person who's taking up that, and maybe sometimes in most of the cases same people who build this company part of the new management. It is not just the new management there team. A lot of people, a lot of families will be dependent on this company. Sometimes it a market failure, wrong timing sometimes. Will obviously doesn't mean many families, so many dreams. This is a shot again at the. So IBC is a win-win scenario. It was brought in as a scenario. Logically speaking, every stakeholder in this game want to move towards resolution as much as possible, not liquidation. Why? Imagine the scenario of a bank. When they give 100 crore, they're just getting 35 on that. No. If you go for resolution, I'm getting 35 is better or 50 is better. Obviously 50. Look at the entrepreneur. What would they say? Like if I am the entrepreneur, I would deserve a second chance, right? I would definitely want to take a second win-win scenario again. It's better than seeing that entire dream collapse. Of course, you will be in control of the company. Definitely better than having bear the guilt of not being able to cater to the families that depended on you. Look at the third player, the new entrant into the scene, Tata Steel. They would think it's a steel deal. They will also have a good profit margin now. Maybe the real estate value of that land might have spiked. Win-win scenario for everyone. Ideally speaking, IBC as a process is the most ideal one to for your bad loans. So, what is the performance of this? Is the subject matter discussion. Survey says it definitely got better, but there are some it's like with every reform. One of the major, since it involved courts, judicial pendency. That's issue number one. Second thing is, entire success of this plan depends on the person who is carrying out, namely solvency professionals, solution professionals who try to facilitate this entire process. It's not a common practice. Like it is not a profession that is in demand. I mean, market demands it, but it is not so famous. There are not enough number of skilled professionals in this arena. So what is this leading to? There is a judicial lag. There are less number of, even when this is desirable, slow. As per the code, it's supposed to be done within a matter of 6 months initially, but processes are extending well beyond an year, which was the original intent of the IBC. Reduce the time for resolution. But we are back to square one. But it's definitely better because recovery rate increased. Now UPSC can ask questions by twisting the technical jargon here. I will ask you a question. If I say that fair value liquidation ratio or fair value to, liquidation to fair value ratio or resolution to fair value ratio, which one should be most desirable? For the backstory, might get if recovery rate is better, does it necessarily mean solution methodology used? In the previous version, liquidation was not happening. They're just sitting on cases. Nothing was coming out of it. So when you say is getting better, doesn't mean that it is always. It can be. Look at the finer detail. Economic survey box. Where is that box? Let me show you. Performance of solvency and bankruptcy. Take a look at the one box that I want you to. Take a look at this page number 111. This chart. Have a look at this. Then here there are terminologies like this. For example, take a look at this statement. Creditors recovered 94% of the fair value of resolved business. What does this mean? Imagine if 60 rupees is 60 crores is the fair value. Out of that 60 crores, 94% is still. What they are saying. Alright. Now this is about insolvency and bankruptcy. All the things that are required for prelims, all you need to know. Next up, we'll be dealing with what is happening in the policy space. What are the decisions taken by RBI with respect to banking sector to the efficiency of banks as well as overall approach to regulation. One of the main aspect being deployment of AI in banking sector. Let's take a look at the major policy actions in the banking sector one by one. So, with uncertainty rising, first point, uncertainty rising, role of a central bank becomes much more important because it is showing that element of balance. This is the first point you need. How is the central bank responding? First is the framework for formulation of regulations. This is something that can be used both your and mains. Framework for formulation of regulations. You know, this is an approach actually by this government in way back in 2004 power is that there are so many ministries because of the coalition government politics. See, division of which leads to a silo based approach in governance. When there is no coordination between various ministries, it automatically leads to delay. Not just that, it is also financially inefficient. When you have duplication of effort, disbursement of schemes, when same scheme comes to the same ministry twice, not only but also the possibility of a leakage. Back then, there was a committee that was set up called the Shivraj Singh Chauhan, which reduced the number of central schemes from I don't know how many, like 50 plus easily a bare minimum of 20 odd. Okay. So there is a consolidation of the welfare schemes that happened. Why is this consolidation happening across multiple schemes? It is in efficiency, and one of the major issue of governance in India, policy coordination. One ministry takes a lot of time in coordinating with another. It is too much to understand. Let me example. You have the Hyderabad water is supposed to handle the pipelines, water delivery, and you also have the and building department which is handling the. Imagine a road is repaired and the next day water department comes up and digs it up, saying that I have to lay down a pipe. What's the point? All it could have mattered was what could have solved the problem is just one phone call or just one text message. Coordination, of effort, wastage of resources, corruption, all of this can happen. Similarly, when you're dealing with multiple circular, multiple regulatory issues, banks sit on those circulars. They are themselves struggling to find out what is the correct action. Have as many as 9,000 circulars lying on our site. Even for RBI governor to sometimes consolidate. First step that they did when they want to carry out this reform is they wanted to have a framework for creating regulations. Because there is no coherence in how you approach governance. Like one governor comes, one team prepares a regulatory structure. The next one comes and there is some other architecture. This lack of continuous approach is giving a lot of headache. What happened? As a result, you will see 9,000 existing circulars and guidelines which were scattered. They were causing a lot of confusion. Now all of them were consolidated and 38 circulars are mandated. Yeah. So it is efficiency. Second, okay, then you have something called the credit assessment model by public sector banks. Before I explain this, let me explain some other concepts which are relevant in this space. Yesterday, when we were talking about the share of credit taken up by sectors, we saw that large corporates are hardly taking 5% credit from banks. Because for these companies, the interest rate is very high. They don't want to take it from banks anymore. They would rather go to capital market. So, if a bank has to give away credit, because bank earn money on loans. Target groups, we have to identify them. Large corporates, then MSMEs, households, rural or agrarian sector, primary sector, and then unsecured loans. People who do not have any collateral to seek a loan. These are the target groups. So when you're talking about this, they are out of the equation now because they are now going capital markets. We are left with these people: MSMEs, households, primary sector, unsecured. When you're talking about the MSME sector, why were banks hesitant to? There is no proper collateral or there is info. If I want to assess the capability of a particular MSME, I need to have a data, right? These people got data because the regular filing tax. They were getting all the regulatory compliances. So they are aware of the credit worthiness of that company. What about this MSMEs? We don't have that data. So, in the context of digital lending, today we have a better possibility. You are not filing GST. Fine. We have alternative methods to assess if this person is worthy of credit or not. Right. So, in the context of this digital lending as a problem that is meant to be solved, we'll have to now understand some terminologies can be asked in prelims. I will write down those terms. I want you to take a guess if you are already aware of it. Okay. The latest credit assessment model for MSMEs by the public sector banks fall under the thematic umbrella of this initiatives taken by the government for facilitating digital lending. Yeah. Let me write down those initiatives one by one. How many of you ever heard about these terms? What is OCEN? What is ULI? Anyone? Someone was telling. Unified Lending Interface. AA stands for Account Aggregator. Finally, CAM stands for Credit Assessment Models. Enabling models for the TSBs, which is about taking decisions. So you can get a question here both at access to credit is a major problem for Indian economy. Critically analyze the issues and also the we'll have to talk about the banking, unbanking, all the market segments, a slew of measures taken by RBI, IBC, capital market, debt market, all the measures taken under specific subheadings, then write an answer. One area where it is a possibility. Till now, we all saw the questions of financial sector or anything related to monetary policy or availability of finance only restricted section. But this time around, this is a landmark shift, series of and the level of depth which our survey clearly quantified everything will make it a possibility that it can be asked even in main section of. So this chapter is extremely important, specific, and you will have to come up with exact data. Yeah. Now let me explain each of this for understanding the concept very clearly. Right. Imagine you are someone take a loan for starting a business. I'm a shopkeeper. Let's say I run a kirana store and I want to get working capital. Right. Where will I go? Let's say today, if that person is not aware, I will go to a bank. I will log in onto some e-commerce app. Let's say, for example, Bharat Pay or whatever is providing the payment solution for UPI. You can have UPI QR code, PhonePe, Bharat Pay, ATM, whatever, OnPay. The Kirana store owner will go to that e-commerce provider and say, boss, I want some, can you provide? That is one possibility. Then they can go to a informal lender. This is extremely risky. They would prefer not to go here. Even in this e-commerce space, there are multiple. You can go to Bharat Pay, ATM, etc. Multiple are there. Multiple login applications. It's a very big headache. Right. Even if you apply in each of those platforms, let's say, they are not actually directly giving, they will have a attached small finance bank, some banking players, they will have to go through some assessment. PhonePe as a UPI app or a commercial app and small finance bank, it ever gets, let's say ATM bank as a small finance bank are two separate entities have to interact. Can't create common standard operating model. Like I want my data in this specific format. If you give as ever you wish, very difficult for me to process. That standard operating is nothing but the Open Credit Enablement CE. So this refers to the principles of interaction. It is nothing but a protocol, like set of rules that banks or all the financial intermediaries and players involved in this game will be using to interact with each other. Clear? This is the layer number one. Now, let's say this part is over. The respective apps, they got the info. Don't you think it's to all of them on a common platform? It's like how interoperable problem, multiple stakeholders coming together, the problem. Got all of them via unified lending interface, which is nothing but a consent driven information sharing platform. Yeah, this is the rule book, the hardware, like architecture on which transactions are happening. Okay, so what will happen is you give consent, there is a workflow enablement between the person who's trying to take the loan, the person who's giving. Okay, so if I am X, the Kirana store guy, and it's a bank Y which is going to give a ULI, just like how transactions are happening through UPI, for lending ULI will be there. But before that lending happens, I think they will need a series of data pointers, right? So this ULI will now attach itself with multiple account aggregators. So the job of this account aggregator is to go find relevant data from multiple sources. For example, they will go to GST platform, GST network, and fetch the GST data if it is available. Link to Aadhaar or PAN card details. They'll fetch that. They'll go to income tax department and fetch for IT returns. So everywhere you have to consent. This is consent based. Cannot be functioning without consent. This can be a statement too. It is voluntary. It is consent based. Without consent, you are not allowed. Say other. Note this. ULI, CEN, clear, and account aggregator, clear, right? Okay. Now you have information. Account aggregator will give the bank this information. Okay. But is information alone enough to take a decision? Right? Still need a methodology to interpret the data. There is a difference between information and insight. What do you mean by the insight? Insight is the wisdom part that you gain from experience. Like, I have this information, I will try to create a story and I will see if I will be able to this person a loan. The ability to take that decision is insight we are talking about. Create that insight. What if we can create automated algorithm? That automated algorithm can. This flow you should understand, and it is important for your. Usually, every year you be getting some questions on UPI of UPI. Lending is a very big theme which has not touched by UPSC. This time I'm expecting some the survey did not explain all these terms, but in the previous version, they explained. We are connecting the this edition, trying to create a narrative here. Credit assessment model, and remember, this is for public sector banks as of now. As of now. So how are they doing it? Via digital footprint. What are these digital footprints? Not important. Next up. One more thing is RBI decided that every initiative that we take should be reviewed once in 5 to 7. Why? Something is not working, we'll have to revamp that. They made it a part of the framework for regulation. That becomes a process. Even next governors coming. Next up, with respect to responsible AI usage. Here is one statistic. There is a possibility comparative question. The statement says Indian banks are known to drastically adopt AI compared to global banks. True or false? It's false. Okay. Only 21% of the assessed banking are deploying AI solutions. Okay. They are still dependent on human labor. One major reason for this is public sector banks will find it extremely difficult to fire people. Okay. And what will you do with all the manpower and also pay for AI solutions? AI adoption will be a bit slow in the public sector, at least in PSC. Maybe the adoption rate will be slightly higher when it comes to private banks. Public sector banks will eventually catch up, but majorly taking decisions, not reducing manual work. Yeah. Now, this is what the survey says. Here in that entire box, anything that would be interesting and important for you. Just 21% of the banks are there. Rest all is for mains content. Secondary in importance. Here we are talking about RBI's free AI initiative. 6 strategic pillars are there. This can be useful for ethical use of AI as an example in ethics rather than directly being used mains economy exam. Get back to this mains phase. Next up is microfinance. See, let's go back. We're talking about the various segments available there. One of the segment is unsecured. Banks won't give unsecured loan. For example, you start, maybe you want to buy a car for taxi. Uber. I think SBI will give it likely. Where you like Shriram Finance, the interest rate is slightly higher, but they have their own risk assessment models. Risk loan, because they'll be making much more money. Historically, see the repayment in microfinance institutions is much more higher than corporate entities. Take an example of self-help group. They don't want to default. The poor people are actually better at repaying their loans than the rich. Microfinance as a idea requires much more impetus or support from government side. This is recognized by the government. What were the so-called microfinance institutions not properly structured, regulated, they now moved away from just being MFIs, microfinance institutions, small finance. Case to the point being AU Bank. Ever heard about this? Vikas Bank. Heard about this? Small microfinance institutions later went on to become small finance banks. When we are discussing the basics of banking structure, you have to know the difference between small finance bank, scheduled banks, differential banking as what are payment banks, what are finance banks, what banks, all this various categories of banks must have already read in the basic classes. If not, back and revise that again. So, in the present context, what survey is talking about guys is one theme that stands out. What is the assumption talking about guys? Uh, which financial index without microfinance loan? Highest segment. What is your answer? Banks? Fintech. Fintech is not a bank, not a financial intermediary. It is a technology layer or technology provider. Volume. Assumption, right? Here is where most of actually the data says maximum NBFCs. This total finance NBFCs will actually have more market share here, followed by banks. So if I were to confuse this trend based question, please note this point. Why you see NBFC dominance? Usually, traditionally, they have a head start. They were the before RBI brought them regulatory. When you are not caring about segment, because you say that get loan, RBI was ignored essentially. At that point of time, even though they are expensive, they gave hope. They have a head start. Once RBI became much more streamlined, see the rise of banks and small finance banks picture. Here is where you will also see that like survey is warning there is a trend of financialization of the small finance bank sector. Long story short, what I'm trying to say, what survey is saying here. Till now, small finance banks had a social objective. Why do you think microfinance as an came up? Not have any kind of hope. Now, once small finance banks are capitalized by equity of venture capitalists, they will again fall back into the same market, defying their own old story of the main intent of microfinance is social objective, not market law. As a state, you should not forget why they exist. Survey is warning of a rising trend of financialization, where there is, pressure of giving out more. The issue here is when microfinance rises, there is a danger of giving more loans than the ability of the person who is taking the loan to pay back. I will take more loan for giving. Same problem that occurred in 2008 global can occur in the microfinance. The warning. Establish more stricter layer. Ensure that financialization is not leading to what the survey says. Next up, financial inclusion. See, or we are still talking about financial only Chandan Yojana. Opening bank account is not enough. Need to use them, right? And use them for what? The access to yeah. Multiple mechanisms should be explored. Bring these people were either to not credit access back into the ambit of our economy. Otherwise, what will happen? They will go back to their money lenders. Will take ridiculous interest rates, 36%, 48%. It is not sustainable for anyone to pay that kind of an interest, especially the poor people, right? So, what factors will drive financial inclusion and what are the initiatives taken? How did they fare? What is the way forward? This is possible question, especially in the topic of PS3 financial inclusion and its performance. There is a possibility of here also. What do you mean by financial inclusion? Don't just say it is bank account. Not just access, it is also the depth of financial activity. So in this regard, you will have to know about two flagship schemes. One is Mudra Yojana and Swanidhi. PM Swanidhi. What is Mudra Yojana? It is meant for people who do not have easy access to credit. Micro firms. This Mudra Yojana scheme, three different categories as a product were created. Sishu, Kishore and Tarun. Okay. These three categories, once they started rolling, after one more additional category out, Tarun Plus. Okay. What do you mean by this? Let me show you. Take a look at this. If you are asking for a loan up to 50%, it is called a Sishu loan. 3 to 5 lakh, Kishore loan. Tarun, 5 to 10 lakh. 10 to 20 is Tarun Plus. What survey says is, ever since this scheme came out, people were taking first 50, starting a business, making some profit, repaying this loan. Now they are moving Kishore category. They're taking more than 50. Then they are taking Tarun loan. What does this indicate? Businesses are getting successful. This is a very good indicator. There is a structured upward trajectory of the loans and their repayment. Very good idea. So, as opposed to the market small finance banks, economic survey says at least when you're trying to social change, government placing itself in this wider role for credit access extremely. So, in this context, there needs to be depth of public sector banks, not just private banks. Okay, what the economic survey says. Now, in this context, second scheme is PM Swanidhi, meant for street vendors. Here also, see, people are taking more, they are repaying. There is one important indicator that I want you to. In PM Swanidhi, the gross NPS is actually more than 10%. Is this high or low? What is the PNP ratio of, what is the percentage? Total loans, public sector, 0.2%. Compare it with a public sector bank, at this Swanidhi, definitely feels like a lot. But it is apples and oranges. Not compare both. Different market sectors. We are talking about a very vulnerable. Sometimes they will not be able, and the state should be not that small losses. Imagine giving a loan of 10,000 crores and having 10% NPA. That. Imagine giving 50,000 and out of that only 10%. 5,000 of their sector. In general, across the world, trend says that anything less than 50% in a microfinance industry, NPA, fair enough. Because it has a social objective and the repayment rate is generally very, even in the worst economies, a GNPA less than fair enough. Even during times, self-help fair their loans. Corporates did not. Self-help groups did. And this is the beauty of microfinance. Yeah. Next up, we have to take a look at sectors, namely markets and bond markets, capital markets and bond market. So we were talking about banking and non-banking and microfinance industry as a source of our capital. The second segment that I want you to, second segment is capital market, that is equity. Third is bond market. Long story short, our survey says there is a significant increase and this is still very shallow. It is not being adapted as quickly as capital market. Lay out the numbers given by survey. If you compare the previous version now, there is a 7x to 10x increase in the number of rerouting their savings from fixed deposits to equity. So go through the data given in the survey. It's not important. Note down the exact numbers. Just go through data. 7x to 10x increase is not just a one-time event. Structural shift in how Indian households are mobile. This is because traditionally, if you take a look at FD, it is not going to be than 7 to 8% because that is the inflation. Like inflation range is supposed to be 6%. Is giving 10%. Definitely, you are in a bad economy. So, as opposed to a FD, even the worst mutual fund is giving 12%. You are averaging it out. And equities, if you are depending on your risk profile, give you anywhere between 10 to 300%, depending on how skilled and how knowledgeable you are in your background work. So, people, the advent of digitalization, AI, and everything are now coming up with equity market marking their additional. But equity markets are subject to market risk. Any global disturbance impact in markets too. And hedge their funds, they are moving their money away from the equity market, gold, real estate. Both of them were obviously very organized. There is a possibility black market, everything that is, a part of GS3 internal security, organized money laundering, whatever is there in the syllabus can associate black economy. Away from that, another set of thought. But overall logic is now in GDP formula discussed. If you are looking at FPIs are exiting India and domestic investors are. So if we can actually create house, don't have to depend on foreign, have to depend on FDI. In fact, if you take a look at 3 straight months negative, yet the markets FPIs have been exiting continuously last 1 year relatively, and yet we are doing fairly well. That question, stick invest. Why? Because they're betting big. Confidence is much higher, and thanks to the regulatory structures, course, there are some here and there. Not saying still far better than what it. That's why equity market is also. So here you will have to know about a new regulation called the Security Markets Code, which repealed the previous three set of laws, namely SEBI, Central Deposit Act, and one more act. SEBI, Securities Contract Regulation Act, and the Depositories. What do you mean by Depositories Act? Saw the Harshad Mehta scam. Will be waiving papers. These are the share deposits papers. So you must have heard the word MAT. So DMAT means basically utilizing the physical copy. So entire market physical and secure that material on a infrastructure have to regulate by depositories. So you will have something called CDS, NDS, multiple that market. They are the places where your share will actually be stored. The infrastructure where your shares will be, and then actual platform trading happens. TSPSC, and then the brokers like Zerodha. All of them require regulation, right? Because of the fragmented governance structures that were there, there were some issues. For example, Zerodha blacked out. There was a 4-second violation of intraday trade, 12,000 the last year, one trading session, 4 seconds delay. So where that loss? But there is no compliance there. Yet that firm regulatory now have a security market code, the trust factor in our economy. Today we need such regulation and enforcement, generate, garner capital. Yeah, all personal details, I think, but you'll have to know what do you mean by market infrastructure, depository, stock exchange, brokers, everyone. All of them will be part of the market. This code can give away some powers, regulate aspects of the entire process. Any of the market, but the one additional development. Till now, they were just recognized, they were registered, not even now they're legal. All this, they will have a legal implication. Much more billionaire like Nick Kamath, an app called something wrong, and people they should be held liable, right? Context of, and then finally we will have retail participation on markets. Why are they not participating? They put not as attractive as equity market. That's all. Why is it not attractive? Because companies there is a lot of competition. Reliance says I'll give you 10% interest, and let's say I'll say that I'll build next rocket. I'll give you 200%. I'm not known in. So corporate bonds are a function of, and that is a issue. Our government has problem with how credit rate. They're not getting enough loans, right? About the bond market. Lastly, we are supposed to talk about the pensions. Today, the average age is roughly around 728. Are in 20, 25 years later, retired people, no savings left. Fund them. One thing, worrisome trend which is not captured in economic but is captured in any other market report, like say CG Consulting. We're talking about how Gen Z is spending money via all loans, fast EMI, what shopping, fast fashion, some discard for a phone that you will barely use 1 year, for sneakers that would cost your fortune, for a trip that you don't deserve, for a hotel stay that can only be afforded by selling a kit. All the while, when they're losing their jobs in an economy that is shambles because AI is disrupting funding. There are no chances. Someone should. So the consumption will add up in GDP. So will the interest rate. So will the bad loans. Which will again amplify the vicious cycle. So banks are very cautious, and even regulatory are now trying to understand this consumption pattern which they don't understand previously. Nobody have imagined that they will take a loan on a trip. Imagine going to a bank and saying that I want, and if the banker asks, like, why do you want? I want to buy a business class ticket. Do you think it is likely that banks would have given that loan? Why are they giving? Because they're betting big on Indian economy. Or they must be that their parents will pay. Either way, it is dangerous and risky game. Jokes apart. Consumption cannot be sustained in a environment where wage growth is a problem. Lending credit growth is increasing in the households disproportionately when compared to wage growth. That's a warning. As of now, there is no metric that is accurately capturing which can create. We spoke about pensions, we spoke banks, we spoke capital market, debt market, insurance. Long story short, again here, insurance, realize the value of it, pay up. Insurance premium come down only when more and more people take it. Definitely the trend is shifting. Not what should you do? Services, more awareness, creating new products, clubbing them with the lending agencies, or just like how PM Fasal Bima did it, make it mandatory, attach a small fee and make it mandatory. All this capture seen as capital access, major factor in. With this, we understood the internal aspects of the next chapter, the external sector. What should you do? Insulate yourself from shocks. External sector, current account deficit, FDI, FPI, what are the trends, possible MCQs, and okay, after this chapter, that is the second most chapter. Ultimately, it's all about money. Economy is all about money. These two chapters are the. That's it for the again meet.